Well, hello again, Solis Wealth family. Greg Solis here with our market update. Our family's doing well. I hope your family is also. Hey, wanted to come out and get out right away on a video with what's going on with Russia and Ukraine. Obviously creating some tremendous volatility out there. As I record this, Russia had just recently invaded Ukraine and the markets are taking a pretty good hit. I always say if I could predict pandemics, weather, war, politics, life would be a lot easier, that's for sure. And these are those outliers that happen. It's the geopolitical issues that are out there. We know those are always a little dicey and hard to predict. And of course, the market does not like that type of a thing and creates a lot of volatility. The big question here is whether we will slip into a recession because of this invasion. Our direct impact economically shouldn't be that great. Obviously, we see oil prices going up, and that could create some issues with inflation. And we know that that's been an issue that we've been watching very carefully. And so when oil prices go up, that creates a little ripple effect across the entire economy because, of course, trucking and everything is impacted. Travel and essentially all the prices could potentially go up. So that's something we got to watch carefully. And it puts the Fed in a little bit more of a dicey situation because they do need to keep inflation under control. But at the same time, we don't want to see this economy slip into a recession. I think the wealth effect and just kind of the uncertainty of the times, consumer confidence will kind of drop a little bit. And so we might see the economy slow down by itself without the Fed having to raise raise the rates a whole lot. So we're starting to see that being priced in. We're starting to see that the bet of the Fed raising at 50 basis points in March versus 25 basis points in March has increased. So in other words, it's looking as though they'll probably only increase the rates 25 basis points or 1/4% in March. And so I think the Fed is going to probably have to slow down raising rates faster to make sure that we don't slip the economy into a recession. So that's a real difficult balancing act. If we don't slip into a recession, typically when we get these kind of invasions or wars overseas, we get a recovery rather quickly. And so we still remain optimistic because corporations still look solid, consumers still look solid, the GDP numbers still look good, and there's still enough movement in the economy. And this might square away some of the supply chain issues, hopefully. Which, as we know, has been a problem. The supply chain, because of COVID, has been a real issue. So that may kind of work itself through with the economy slowing down a little bit. Maybe the demand isn't as high. Maybe products and services are more available. That'll calm the inflation numbers down, which will give the Fed an opportunity to maybe slow down having to raise rates faster to keep inflation under control. I know that's a mouthful. I apologize, but it is kind of complicated what's going on right now. But overall, the markets are down, peak to trough. The NASDAQ is kind of tickling around bear market territory, down about 20%. The S&P 500, not as bad, but it's been, about 12, 13% pullback from peak to trough. So just a lot of volatility out there. The good news is there was a flight to quality, which means that there was money going into bonds. So year to date, bonds have not performed well because we had a rising interest rate environment. But now with the little concerns with the war, there's a lot of money going into bonds, which is, making rates go back down a little bit. And of course, that's balancing the portfolios out a little bit, which is nice. So at least we got something in the portfolios that's doing a little better. And that's the bond portion of the portfolio, as the stock portion is taking a little hit. So other than that, everything's positioned well. Obviously, the amount of equities that you have in your portfolio is the degree of risk that we understand we're taking. So it's normal. We've got it properly balanced for the degree of risk that we feel the client is willing to take. And so overall, everything's in good order. Everything's doing what it should be doing. It's just one of those volatile times that we kind of expect. It's not a matter of if the bear market comes, but when the bear market comes. Is this it? Not sure yet, but there's certainly a lot of volatility with what's taking place with Russia. So definitely a headwind right now. I'll keep you posted. If you have questions or concerns, obviously don't hesitate to give us a call. My very best to you and your family. God bless.